Okay, so there's this huge kind of invisible scramble happening right now, completely changing where your stuff is made. It all kicked off because of a big shift in US trade policy, but the ripple effect is a fundamental rewiring of the entire global manufacturing map.
I mean, just take a look around you for a second. Your phone, your t-shirt, whatever device you're watching this on. For like decades, the answer to where was this made was almost always China. But that answer is changing, and believe me, it is changing fast. So let's dig into this great manufacturing migration, because trust me, it has huge implications for businesses, for economies, and for you and me as consumers. Think about it. For so long, China was simply the world's factory, period. But that era, it's pretty much over. Companies are now pivoting their supply chains out of the region at a pace that we have just never seen before.
And if you want proof, just look at this number from Wells Fargo, a 44% drop. What does that mean? Well, a decade ago, a whopping 90% of supplier volume came from the China region. Now, it's just 50%. That is a colossal shift.
So you might be asking, how on earth did this happen so fast? Well, this timeline lays it all out. The shift had already kind of started before 2018, but then, boom, the trade war tariffs hit and it was like pouring rocket fuel on a fire. The pace of companies moving out nearly doubled in just 2 years, which is how we got to the even 50-50 split we're seeing today.
Okay, so if it's not China, where's all this work going? Well, it's not just one place. As Jeremy Jansen from Wells Fargo points out, a whole group of nations are stepping up to fill that gap. We're talking Taiwan, Vietnam, Indonesia, Thailand, India, and Malaysia.
All right, so let's meet the new players. Who are the big winners in this massive trade shift? Let's take a look at the new hubs that are rising to meet all this new demand.
And what's really fascinating is that this isn't just about a factory packing up and moving. We're seeing the birth of what experts are calling new trade corridors. Think new shipping lanes, new money flows. The entire economic map of the region is literally being redrawn. And look, we've got the numbers to prove it. This data from Project 44 is pretty mind-blowing. Vietnam up a staggering 23% in container volume to the US year over year. Thailand and Indonesia are seeing huge jumps too. These are the clear winners, right here. And of course, there's the other side of that story. While those other countries are booming, check this out. Sonar data shows US imports from China have plunged 26% year over year. It just confirms this massive realignment we're talking about.
But hold on, because this whole thing isn't just about where the boxes are coming from. There's a hidden financial story here, a serious cash crunch that's hitting businesses really, really hard.
I mean, just try to wrap your head around this. According to HSBC, before all this, the average tariff on these goods was tiny, like 1.5%. Today, we're talking double digits. That's a huge new cost that companies are suddenly forced to deal with. So what does that actually feel like for an American importer? Well, first, that extra inventory they bought to dodge the initial tariffs, it's running out. Now, those super high tariffs are hitting their bottom line directly. And if you're in a business with thin margins, like retail or clothing, man, that's incredibly painful. It all boils down to one thing: a desperate, urgent need for cash just to buy new stuff. So in this brand new high-cost world, one thing becomes crystal clear: cash is king. The question is, how are these companies fighting to stay afloat?
And this isn't a small problem. We're talking massive scale here. HSBC surveyed 1,000 US companies, and get this, 70% of them said they need more working capital. That's a huge chunk of the economy feeling this pinch.
And just so we're all on the same page, working capital is just a fancy term for the ready cash a business needs for its day-to-day operations. You know, paying bills, buying supplies, making payroll. So when 7 out of 10 companies say they need more of it, it means they need more cash in the bank just to keep the lights on.
And this quote from HSBC's Ajit Menon just nails it. The safety net of extra inventory is gone. He says companies will need more working capital. And then he says the line that sums it all up: cash is becoming king. It's not a luxury anymore, it's about survival. So what's the game plan? Well, companies are basically doing 3 things. First, they're out there trying to find new financing to get that cash. We're talking a 20% jump in financing flows. Second, they're going back to their suppliers and trying to renegotiate, basically asking for more time to pay their bills. And third, they're looking at their entire supply chain all over again, but this time, not just for cheap manufacturing, but for better financing deals. So here's the big takeaway, the thing you really need to remember.
This whole thing started with a change in trade policy, right? But it did so much more than just move some factories around. It has completely rewired the flow of money around the planet. And that creates a whole new set of financial pressures that can end up affecting everything, right down to the price you pay at the store.
And all of this leaves us with one final, really important question. This whole new manufacturing map was built in a huge rush, under a ton of pressure. So, are these new supply chains actually built to last? Are they truly resilient? That right there is the billion-dollar question that everyone is trying to figure out right now.